Good morning or afternoon, everyone. Thanks for joining us today. Welcome to the Family Zone Investor Conference call. All attendees now are in listen-only mode. On the call today, we're joined by Family Zone MD Tim Levy and CFO Ben Jenkins. I'll pass you across in a moment to Tim to kick off our discussion of the company's latest progress. We'll have a presentation today, after which we'll all have an opportunity for Q&A. If you would like to ask a question during the presentation, please type your question into the Q&A panel within the Zoom app, or if you have dialed in using your phone, you can always email questions across to me at tim@nwrcommunications.com.au and we can address them that way. So to kick things off, I'll hand over now to Family Zone MD Tim Levy. Go ahead, Tim.
Great, thanks, Tim, and thanks everyone for attending, and also welcome Ben Jenkins, our CFO, I think for his first time in the spotlight. So Ben's here to answer any questions that people have. So what I'll do this time, people have probably already had an opportunity to go through this presentation. This is our quarterly update. So I'll quickly run through this in 15 or 20 minutes and then hand over to Q&A. And again, Ben Jenkins is here and I'm more than happy to answer questions. So this is September quarter, I think was a really important one for our business because it was, we had a year of the Smoothwall business as part of our group and nearly a quarter, 2 months at least, of the Custodio business being part of our group. And it really was an opportunity for us to kind of showcase the financial impact of all the efforts that we've been doing around top line growth, cost of sales, margin control, and obviously fixed cost control. And it was a pretty remarkable quarter. We grew materially, grew something like the equivalent of 25% year on year. We generated our first operating surplus of all time, collected more than $23.5 million. I think we clearly demonstrated the ability to control our costs, and I'll talk more about that in a moment. Continuing to improve our SaaS metrics, and I think without doubt we are world-class now, particularly in our education business, and have expanded our product portfolio with the acquisition of Educator Impact, and there is more to come. So let's quickly go through some of those things. I won't bore you with the board. So we ended the quarter with more than 12 million students, 24,000 schools, $83 million of recurring revenue, nearly 300,000 paying parent accounts at 17% of the US school districts. That is a remarkable achievement for this business, and we are now, without doubt, the only true global provider of online safety and the only online safety provider with an extremely diversified stream of revenue, including where our revenue comes from, obviously, and then the currencies in which we operate. So it's a really great place for our business to be. Okay, let's quickly go through the numbers. Let's start with education. So our education business punched through $64 million of ARR, I think it is. So we grew around $3.5 million in the quarter, principally out of the US. The US has grown net new business, so new customer growth, but importantly and remarkably, 135% net revenue retention. And I still don't think the capital markets appreciate the value of net revenue retention. What that means is for any renewal opportunity that we get, in a particular period of time, we're adding 35% to the value of that customer base or those opportunities net of churn. So if we collected $23.5 million of cash flow in the September quarter last year, then 120% net revenue retention suggests $30 million of collections in the equivalent quarter the next year. That's what's in our business now. Not only a good customer base, but a customer base that's growing from existing, price increases, additional products, cross-sells, upsells, and so on. I truly don't think the market in Australia understands SaaS businesses and the value of net revenue retention. Our US business is now, when we acquired Smoothwall middle of last year, I think our US ARR was about 15 million, and the Smoothwall UK was north of 30 million, or just close to 30 million. Now the US ARR is about $30 million, just shy of our UK business. So the growth in our US business has been phenomenal, something like 100% year on year, as again, a combination of existing customer growth plus net new business growth. We don't talk so much about student licenses anymore, but of course, net new growth does bring with it more students, and more students brings with it more parents, which I'll talk about in a moment. As you can see here on the chart on the right-hand side, the US business is now almost caught up with the UK, which is an unbelievable result out of our US team. So looking ahead now, education business pipeline is strong. I'm feeling pretty confident about the December quarter. Of course, it isn't the biggest sales period in our business, but we're looking pretty comfortable. We ended the September quarter with about $10.5 million in qualified leads, about $4.5 million in weighted leads. That means we've qualified these leads and we apply a percentage likelihood of winning them. And those who've been following us would know that it's a pretty good analogy of the next kind of quarter results. I'm feeling pretty comfortable about our pipe. And coming soon into our pipeline is the AI Pulse product, which was brought into our business a month ago or thereabouts. And we've got some new educational oriented and wellbeing oriented products, which will also be launching in the early part of next year. So feeling really good about our pipeline and our growth opportunities from here. So overall, now including education and our custodial and our consumer business, we've punched through about $83 million on a pro forma basis of ARR, including Educator Impact. And again, this represents a very diversified revenue stream: consumer, education, different currencies. We're really in a fantastic place financially. And you can see that despite some big swings in the exchange rates in the last, at the end of the quarter, the impact on our ARR was only slightly positive, about $1 million. The standout, I think there were standouts across our business, but one of the big standouts for me was the custodial business, which was with us for about 2 months. And on a pro forma basis from 1 July through to 30 September, it grew ARR about $1.7 million. And that's essentially, the lion's share of the growth that's predicted in that kind of underlying custodial business they've delivered inside the first quarter. And so I'm hoping for continued growth in their current business, plus as we introduce the custodial base to our school parents in the coming months, I'm expecting really big things from what is already an outstanding performer within our business. We couldn't be more happy with that custodial transaction. Okay, and then this is probably the key, I think, things that the market's been asking us to talk about. It's the building of operating leverage in our business, and then the turning that into operating cash flow, which of course, as I said, we achieved our first cash flow surplus last quarter. So, achieving a cash flow break even, a run rate break even is impossible if you don't have operating leverage, and we've clearly got that, and it's only getting better. We're now slightly changing the way that we're talking about margins, because with the Custodio acquisition, we've got proportionally a lot more marketing spend in our business. So we're now splitting the concepts between service margin and gross margin. Service margin is revenue less IT costs, data, hosting, hardware. And gross margin is service margin less marketing and channel costs. So in simple terms, at SaaS businesses like us, they try and grow service margins as high as you can. We think we can get to 90%, maybe even more in the medium term. And then you try and manage your gross margin, the difference being your marketing costs. And so that's where I'd like our business to get to: 80% gross margin, 90% plus of service margin, and spending about 10% of your revenue in marketing. So ever increasing spend on your marketing. That's kind of what our internal targets are. At the moment, our absolute focus is pouring that gross margin into our overhead so we can hit break even. But in time, as that flips in the coming months, you'll see us have more money to spend in growing our business, which is very exciting. Now, so our margins, as you see from these charts, are tipping up quarter by quarter. We did have to spend a bit in the last quarter to invest in the kind of back-end costs for back to school in the US. So I think you'll see that those margins will tick up a bit in the coming quarters. And again, most importantly to me, average revenue per student is ticking up every single quarter, because every quarter with our average deal that we're selling to our enterprise customers or our school customers has more average license fees per student than is in our existing customer base. So you'll keep seeing that ticking up. Our plan, or our kind of objective, is to get to $10 average revenue per student per year in our schools business in the medium term, next 2 to 3 years. If we do that, our existing business would add in the order of $40–50 million of ARR without any incremental cost. So that's the opportunity of net revenue retention, growing additional products, selling additional products. And most SaaS businesses, if you're investigating, most SaaS businesses nowadays are speaking mostly to growth from existing customers. Okay, B2B2C. So this is the launch of our consumer offerings through our US schools. Now we've got the access to the outstanding Custodio product. So that's in trials today. I'm very, very comfortable with the take-up, the activation rates and conversion rates. They are way higher than we would expect. Having said that, don't get ahead of yourself. It's very, very early days in the pilot. We're expecting actual launches, true launches in Australia, New Zealand, and the US this month. We possibly will also have a significant launch to 30,000 parents this month in the UK. So it's an ongoing process, working with schools, piloting, getting them confident, getting sales momentum out there. The chart, I might just touch on the chart. The blue column is the US school districts that have taken up the concept of our online safety hub, which you see on the bottom left image there. Which is the way that schools now talk to parents about online safety is using our platform and our messaging, and that becomes the kind of gateway into the Custodio parent app. As you can see, interest in that proposition has absolutely exploded as we've now been showing these school districts our capability and what the Custodio parent app has available to them. So look, we're treating very carefully. If you get this wrong, you don't get second chances, particularly with issues around privacy, but we're feeling very good about where this product is positioned. So Custodio, as I said earlier, that's been a tremendous welcome into our family. They've actually, the chart here is 9,000 of consumer growth. It's actually Custodio on its own added 20,000 accounts in the September quarter, which is phenomenal, and 1.7 million of ARR. So they're doing very, very well, and really a leading light in our business. I'm very, very pleased. Okay, so this is, I think, the key that investors are looking at for us. When is that inflection point coming? And this chart really talks to that. The grey box behind this chart is our gross margin. Gross margin, again, is our revenue multiplied by our gross margin percentage. Our ARR at the moment of around about, let's call it 84, and our gross margin at the moment of around about 80%. Says we've got about $65 million of gross margin in our business on a run rate basis, on an annualized basis. Our fixed costs are in the order of low $70 million. And the difference between those figures is the gap between is the gap to our break-even point, our run rate break-even point. It's something like $8 to $10 million. And so in simple terms, if we add $12 to $15 million of recurring revenue in our business, we're at that inflection point. So obviously the key in our business is to have control of our costs, so that the extra margin that we're adding isn't being is materially surpassing the extra costs that are growing in our business. And we've done that in 2 quarters in a row. It doesn't show as much in the Q4 22 here, but you can clearly see in Q1 23 the growth in our margin is materially, significantly higher than the growth in our costs. And our costs are pretty much steady now. Of course, we've just acquired Educator Impact, which will add a little bit, but we estimate in our business there's something like $5 to $6 million of fixed costs associated with people who are largely doing the same job, looking after similar sorts of technologies in different parts of our business. Over time, we'll be able to consolidate those jobs and redeploy those people into other areas, possibly bank some of that to our bottom line. But the bottom line is, or the real message I'd like the market to understand, is our fixed cost structure is now well under control. If anything, there's kind of downside risk, I feel, on our cost structure. And so therefore, I've got high confidence that every dollar of ARR that we add, 80 cents of that will drop to that bottom line. So we're in a really good spot. If we can hit the 100 million of ARR by the end of this year, that's $80 million of contribution. We're home. Really, that's what this business has been talking about for a while. We're really running as hard as we can to get the 100 million of ARR and cross through that run rate break-even point. The other thing that's obviously important is it's not just about accounting of break-even. It's actually about the cash flow break-even. And one of the standout achievements of our business is the conversion of recurring revenue into cash flow. We collected $23.5 million in the quarter against an ARR of just over $80 million. By anyone's language, that's an outstanding result. we're expecting to continue to deliver good cash flow in the coming quarters. Of course, September is the highest cash flow collecting period for us in our education business, and it kind of tails off. But you will see in our business a flattening of the collections curve as we're broadening our product set, and in particular as we've now got Custodio, which is accounting for 20, well, probably 30-40% of our revenue, and their cash flow follows different cycles, more of a retail-oriented cash flow cycle than in the enterprise space. So the outlook. So we're launching Custodio through our school channels essentially immediately, and it will be building in the coming months. The Educator Impact product, Pulse, is launching in the UK and the US properly in January. In fact, we've got a substantial trial underway at the moment in the order of 12,000 students. Very excited with where that product is going. We're launching some education products. It's called this Digital Experts Academy. Actually, that's to be launched in February. We've already won a contract of $120,000 for that product. More to come about that part of our business in the coming quarters. Very, very exciting. And then we also will be rebranding globally our business over the next kind of 12 months. So I'm expecting to be able to communicate that to the market in the March quarter. In our terms and cash flow, last quarter we showed this chart on the right-hand side, which is our quarterly cash flow report, but kind of restructured in the way that we talk to the market about our financials. And I think it's a better way to represent our cost structure. And the good thing for me is our cash flow that you see here meets, matches quite nicely with the financials that I showed in the previous slides. And so that's showing in the order of, early $70 million of fixed costs. As I said, I believe those fixed costs are pretty much capped now, and we're just growing our revenue comfortably, and moving into our big sales cycle in the US and the UK to cover that gap that I mentioned. So feeling really good about our cost structure and approaching a break even. Now, I just thought I'd touch on this. I've had a few questions about our M&A activity, and obviously there's a view that businesses like ours really need to focus on execution and focus on break even. So I guess the purpose of this slide is to show that we've had a very deliberate strategy to build out, the wagon wheel, there's probably a better name for this, of products within our portfolio to meet our aim, which is protect and support every child's digital journey. And the good news is all the key things that we need, we now have up our sleeve. So all those components from security products to filtering to classroom management to safeguarding, educational services, consulting services, we have it all now. There's nothing on the horizon that we need to deliver on our mission. So feeling very, very good about that. All of these products that we have in our portfolio stand alone and do really well. And as we bring these together, I think they're all going to magnify in the value that they offer the customers and our business. So bottom line is, at the moment, with the share price as it is, we're pretty much just going to focus on what we're doing. So this is what the current portfolio looks like. It's an outstanding set of products, class leading essentially in all of the areas. We're feeling really good about it, and now increasingly focusing on integration and reducing the cost to manage and deploy. That's really it. I might just hand over to some questions.
Excellent. Thanks, Tim. Covered plenty of ground there in sort of 17, 18 minutes, so that's great. For all attendees, please pop your questions into the Q&A panel. We're keen to address as much as we can. I might jump into a big question straight off the bat, Tim. So I think you made the point just then, the key things you have now are up your sleeve and there's nothing on the horizon you need. Question that's come in is, when is the company going to give more focus on generating profits from the existing portfolio rather than pursuing further acquisitions to expand the coverage from here?
Yeah, well, that's the point I made is, we can't be ignorant to the requirements of the capital markets, of course, but on the flip side, the people we compete against, who are all private market backed, don't care. They frankly don't care how we are positioned, and the struggles of integration and the capital markets and cost of funds and so on, and we have to compete against those. Now, we've had a very clear strategy of building out that wagon wheel, and we've done it, and I think we've done it brilliantly. And we've not only done that, we've not only found products that kind of complement each other, but we've actually brought them into our business and on-sold them to existing customers. I think everyone would give us a big tick for that. So I feel like that strategy was the right strategy, and yes, it's been hard on investors and hard on our business as well, which I acknowledge. Fortunately for us, that hard work's now done. Now it's about integration, adding value to those products, and adding value to our customers. So I don't expect, whilst the capital markets are like they are, for us to be thinking about M&A type opportunities. I think we have all the products we need to literally win in the markets that we operate. So now it's just head focused on this kind of break-even point and beyond.
Good stuff. Thanks, Tim. Sticking with M&A, but the other side of it, which is sort of more the integration. The questions come in, can you talk to the integration of all the different products and brands? Do they link together? Is the integration simple, i.e. are they written in the same programming language and similar architecture, all these sort of things? Can you talk to that?
That's a lot. Yeah, it's difficult. There's all sorts of technologies involved in our business and all sorts of brands. We have been working, we've been just trying to prioritize what we integrate to identify the products that are most easily saleable, in particular in the US. So the focus has really been about safeguarding technology and taking that to the US. There is, as I said in the beginning of this session, we think there's something like $6 or $7 million of costs in our business where there's duplication in people who are supporting bits of technology. So that will flow through our business. And you can't click your fingers. You've got millions of customers, students that are using particular bits of technology that you can't just shut down. You've got to refactor, integrate other platforms and so on. So that's going to take 12 to 18 months. We've got a very good plan for doing so. And so, as I said, I've got this kind of cost structure improvement that's going to accrue to our business in the next 12 to 18 months. But we're also super sensitive to making sure that we're delivering on customers' needs in the market. So look, it's a big process. It's complex, involves technology and people. But you know, I think we're doing this very, very well.
Cool. Sounds good. Thank you. So starting into the one of the business units, Custodio. So the question is, you referenced 30,000 UK users of Custodio. Are they fully paid subscribers, or is that?
No, I need to be much more careful with my language, don't I? No. So what that is it's a big, let's call it a school institution in the UK that is interested in working with us on supporting their parents with online safety, and that's holistically. It's a holistic approach which includes online safety education, includes online safety content for all the stakeholders in the institution. Includes face-to-face delivery, parent nights, and so on, and it includes access to the Custodio parental control app, both the free version that we offer and then the premium version where the parents pay. So it's a very, very much a holistic approach to this. We're seeing it as the opportunity to really showcase what our organisation is capable of, and I'm really hoping that happens this month. Certainly, this side of Christmas would be an outstanding result. Again, our focus with all these things is about showcasing, one, but also making sure there's three things, right? Showcasing what we're capable of, two, adding value to the parent, and three, making sure we don't create noise for the school. That's really the focus. Yes, I'd like millions of parents doing this stuff, but really the focus is those three elements at the moment.
Thanks, Tim. I mean, those three elements, that probably feeds into another question, which is coming at it from a different side, which is still with Custodio. The question is, can you talk about your confidence levels of launching Custodio into schools and targeting parents, and can you describe any of the challenges in executing that plan?
Oh, look, it's a complex thing, of course, because you're allowing the sharing of data between a school and the parent, and that brings with it issues around marketing, using school data to market, which is a challenge in some regulatory areas. It's the sharing of data, which has data protection implications. It's encouraging parents to buy a product, which can look a bit icky for a school. So there's kind of commercial, regulatory, and technical challenges in doing that, which we've been working for a while, and we're mostly through all of those. The thing that makes me excited about it, and I've been excited about this segment for a long time, is one, the need's clear. You know, go to any barbecue and every parent will talk about the challenges of kids' access to, your kids' use of screen time and access to inappropriate content and so on. Schools, as you saw from the chart early, are keen. 600 districts in the US have now said that we want to be part of this. And the other thing that makes me really excited is the Custodio team are outstanding. They very focused, very data-driven, know their customers, know their product. So I think we've got all the ingredients now. It's just about execution.
Yep, well, that leads nicely into another question on Custodio, but also on Educator Impact. The question is that given the breadth of offering you now have following those two acquisitions, Educator Impact and Custodio, can you talk to how much you think your lead over the competitors has increased?
Yeah, that's a good question. There's, depending on who you're talking about, and our competitors are Lightspeed, Securely, GoGuardian. We're all kind of competing in these sorts of areas. Are all starting to talk beyond filtering and classroom management and about learning outcomes and student wellbeing and social emotional learning and stuff. We're all kind of getting into it. I think we all have a different approach. I think what's important to our business, and I think it's unique about our business, is the idea of embedding insights and expertise and education inside our platforms. I think our thinking on that is miles ahead of anybody else's, and I don't think anybody else is as passionate about the underlying kind of protecting the child as we are. And then, of course, the parental control offering, no one has anything remotely like our capability. That is a true competitive advantage. In bits and pieces, of course, everyone has their little competitive advantages. I think fundamentally we're a better organization than those we compete with, and I think our proposition is better. I think, if I think about, again, everything that we're trying to achieve as a business, we've without doubt got the better and more broader product suite. Hopefully that answers the question.
Yep, sounds good. Thanks, Tim. So taking a step back to sort of a group level view, can you talk to your expectations for the overall growth rate going forward? Or if you took the last 12 months growth from all businesses as that group level growth rate, had you have owned them had you owned them then as you do now, is that a reasonable expectation going forward, I guess, is the question.
Yeah. Well, look, so in the September quarter, we're operating on a run rate growth of 25% year on year, which is pretty good. And that, look, in my mind, that's kind of base level. That's where we should be targeting. I think we have a lot of call options in our business that could make that significantly higher. And that, we're touching on the Educator Impact, getting into wellbeing type products, Custodio, selling through our massive amount of student base into the parents. Our net revenue retention on our education products is huge in the US, and it's not so high in the UK, and that's a function of integration. We need to get more of our products into that UK market and more integrated. So, I'm kind of personally, and this isn't a forecast, but I'm personally hoping in the medium term to get our global NRR in the schools business north of 120%, and then having net new growth on top of that and the consumer growth on top of that. What does that translate to? I don't know, do your own sort of modeling, but north of 120%, up to 150% is a business like ours could possibly get to. We need the integration work that I was speaking about to come together to really do that. But yeah, I think that's within the realms of possibility.
Yep, sounds good. So talking back to your competitive advantage, the question is that have the acquisitions positioned Family Zone to continue to take market share from your main competitors as they don't have as full a product suite as your business does?
Yeah, I think so. The market in the US in particular is very much thinking about ecosystems and one throat to choke or one-stop shops. It's very much the kind of ERP sort of concept of selling into safety is appearing in the US. The more problems you can solve, the easier it is to acquire, and also, frankly, the harder it is for you to be displaced. So I do feel like it's giving us a competitive advantage. Of course, we're not unrealistic. We recognize that this changes the way that we have to talk about our products, because we're no longer just selling a product and the product. And the product, we're now having to sell solutions. We're having to talk about, having to train our salespeople to talk about student wellbeing and social emotional learning. These are new concepts. So we're having to build out cross-selling teams and consulting, solutions-oriented sale techniques. Now, this just isn't peculiar to us. Our whole industry is going down that path now. So it's really interesting days. Again, I feel like our strategy is the right one, and our depth of experience in this stuff. We've got, I don't think everyone knows this, we've probably got about 14 people in our business, if not more, that are true experts in online safety and education and mental health and psychology. And that kind of grounds our product and our strategy and the way we communicate with customers, way ahead of all of our competitors. So I do feel like we're in a really good position in a market that's blown up as the safety industry is kind of getting out of its safety focus into more wellbeing areas.
Thanks, Tim. Question on the industry landscape, government funding. Can you provide an update on the speed of US funds moving down from presidential announcements down to appropriation and then to the capital actually being spent on services that you provide? And is there any differentiation you can make between the Trump funds and the Biden funds that you can talk to?
Oh, look, I haven't got all the specifics of it, but I know that the Trump funds are still not deployed. I think there's another 12 or 18 months on that. And then the Biden funds around the future of education and mental health and so on, like that's like $140 billion. That's going to take years to spend or to appropriate. And again, I don't think the market gets that either, right? In education, funding goes up with CPI for kind of core services, and we are a core service. You have to have a filter by law. You have to have classroom technology to have a functioning classroom. And now with the issues around mental health and suicidal ideation and guns being brought to schools and so on, you have to have monitoring technology. And in fact, in the UK, that's required by law as well. So, we become part of the infrastructure of a school that's required, and therefore that goes up with CPI. So the stuff that we sell, the core stuff that we sell, prices just go up with inflation. And then you've got these literally tens and tens of billions of dollars sitting there in these appropriation pools, and we can work with our states and district partners to try and pull down those funds for specific programs, online safety, safeguarding, wellbeing measurement, and so on. And that's going to take years and years and years. So we've got a massive cushion. I know the market's concerned about inflation and interest rates going up, but it truly is not going to affect our education business. In fact, probably the opposite. Education is one of those areas that governments seem to fund through these sorts of challenging times. And then on our consumer business, I often hear the question, what about parental controls? Will people not buy parental controls because they can't afford to eat? Well, I'm sad to say that parental controls is a leafy suburb problem. And those parents, the parents of those kids aren't really going to be that troubled by, interest rate increases. So I feel like our business is really immune to the challenges of the next few years.
Excellent. Thanks, Tim. Question that's just popped in. Where will growth be driven by in the UK? I guess that's a product question.
Look, in the next 18 months to 2 years, it will be a little bit of core growth in the core business, a lot of growth in safeguarding, which is now required by law there. I'm expecting big things in the introduction of the Pulse products, the wellbeing measurement into that market. I'm expecting big things with the launch of our educational offerings in that market. The UK is quite mature when it comes to things like online safety education and wellbeing, and we've got a really compelling offering now. So I feel like that's where the growth. So it'll be kind of side by side growth in the UK in the next couple of years, and then as we integrate the smooth wall filtering and firewalling product into our cloud platform, I think then their kind of underlying core business will motor ahead as well. So fortunately for us, we've got all these other lines of business that we can sell in that market, and then filtering and classroom management, I think will take off in the next kind of 12 or 18 months.
Cool, sounds good. Change gears to a few financial questions now. So question that's come in, thanks for the frank presentation of your financial model. Can we really factor a fixed cost base of 70 million when revenue is, say, 200 million?
Depends where the revenue comes from. So if that revenue is coming from consumer, if that big chunk of that revenue growth comes from consumer, then our support costs are very low for selling that revenue, and our cost of selling of that is very low. Our margins on that is huge. If the growth is in UK sales, where we only get half of our sales through the channel and half through our sales team, then maybe not. If the lion's share of that growth comes from sales in the US, where in fact all of our sales now come through the channel, then probably so. So look, it really depends on the source of the growth. We've got in our business an increasing group of people that focus on content moderation. We feel like we can reduce the cost of moderation by 50 or 60% in the next couple of years. So I feel like I can mollify any growth in sales against those costs as well. So look, at 200 million, it's going to be hard, but again, it depends on where the revenue comes from.
Seems like that's the burning question.
Sorry, it's definitely worth adding that it's not going to be across the business in the back office. It's the sales and supports area that Tim's referring to. It's not the finance, tech, HR people, those sorts of areas. So it'll certainly deliver more margin to the bottom line than what we're currently getting.
Yep.
Excellent. No, I was just going to say, Tim, that content moderation cost seems to be the big thing that Elon's grappling with over at Twitter now that he's got the keys to the factory. So another one that's just come in. You mentioned bidding into a number of $1 million deals in the recent quarterly. Is there any more light you can shed on these opportunities?
Those sorts of deals, these are countrywide, statewide type deals. There's a number of them going on. We raised it in this quarterly for the first time. I know I've spoken to it, but I've never written about it before because there's so many of them. We're being invited so frequently now into these sorts of things. I feel like it's a big turning point in who we are as a company. With any of these deals, we're talking about multi-million-dollar per year deals. With these deals, they are complex sales, long processes, including proof of concept trials, and quite often, in fact, if I think about it, every one of these ones that we're engaged with at the moment involve us essentially proving the efficacy of the product set and then seeking funding. So it's a little bit indeterminate. It's hard to know, well, this is, a tender that needs to be done by such and such a date. It doesn't kind of work like that with these sorts of deals. There's a tendering process involved to select preferred vendors, then you have trials, and then ultimately, if it's successful, they then have to seek funding. And that's kind of where these deals are at. But again, we're talking to them because it's been quite transformational what's happened for us the last couple of months. Big states and countries across UK, the US, and Australia have started working with us on these sorts of deals. It's pretty remarkable.
That's awesome. Just to back on that moderation question, another investor's asked, can you explain why you think you can reduce the cost of moderation?
Yeah, it's basically the use of artificial intelligence, machine learning. So, I'll give you an anecdote. So we've got about 45 moderators who handle, would you believe, 130,000 captures a day. So our systems are logging, it's like over 100 million events every single day, and 130,000 of those every single day go to our team based in the northern UK, who go through it and make a judgment, make an assessment as to whether this event or this activity is toxic, and if so, then there's agreed escalation protocols with the school. Our AI team have been running through the history of captures, and if you think about it, those moderators are essentially labeling. They're determining whether this particular activity is toxic or not. And so, analysing all those labels, we've determined that we think we can reduce the amount of captures that have to be handled by moderators in the order of 20 to 40%. We think we'll be able to pull that off in the next month or two. Our team, and I've asked them to put their proverbials on the line, think they can get that to 60 or 70% in the next year or two. So it's just, again, using and to give you a little bit more example of what these kind of tools can do. So, we can, for instance, if we see a bit of text in key logs or in a search term, the tools that we've got now can actually put that into Google effectively and search the first 2 pages of Google results and kind of analyze that to see, well, what is it likely that this child was doing? So we heuristically can kind of analyze what these bits of text that kids are writing to each other or searching online, and make some assessments as to what this kid's doing. So injecting that into our product can have enormous benefits in the way we categorize, the way we moderate, and so on. So yeah, huge efficiencies coming through that.
Yep. And I guess as an adjunct to that, the question is, are you saying that the volume of alerts to moderators is increasing at sort of an exponential rate, or is that not the way to view it?
Look, I don't get a sense it's increasing per se. I get the sense, I understand what that question's asking. Are kids taking more risky or more toxic activity? I don't get that sense. I think we're getting more and more efficient at identifying it and targeting it, but no, I don't get the sense that there's more toxicity. I just think that the level of toxicity is frightening.
Yep. Just back to a few financial questions. What sort of sustainable EBIT margins do you think you can achieve while still growing revenue over the next few years?
How do you want to answer that one, Ben?
I think that's a tricky one to answer without providing guidance to the market, to be perfectly honest. So I think you'd like to think we could aim for double-digit margins and strong double-digit, but I'd be hesitant to put a specific number on it.
Yeah,
but our competitors all seem to try and operate in the rule of 40, right? They're all trying to work in the 80% margins, 35 to 40% EBITDA margins, and maintaining growth in the orders of 20% to 30%. I think we have a really outstanding suite of products, outstanding sales capability, and I'd hope that we can match that.
Yep. Question for Ben: from a cash flow and balance sheet perspective, what do you view as the biggest risks moving forward, given the market tailwinds look to be strong?
Look, I think the biggest risk really achieving the growth plans. We've got a fairly diverse set of currencies across the world, so I think the hedging risk or the FX risk is sort of balanced against each other with costs in country as well. So I'd say I'd put that as a reduced risk compared to it's just execution that Tim talks about at the start. So if we don't execute, then the cash won't follow. Where if we execute our growth plans, then the cash will follow.
It might be worth putting that to you as well, Tim. Just at a business-wide level, not just sort of from a cash flow perspective. Any of the sort of the risks or considerations that investors should be mindful of, to cast that against the positives and tailwinds and opportunities that we've discussed in the call.
Yeah. So look, if the focus is on the break-even point, then the risk is top-line sales. I feel like hand on heart, I think the market should be confident in our ability to grow top line. I think we've demonstrated that for a couple of years now. Gross margins, I think the market can be confident that we've got good control of our gross margins on our fixed costs. I think over the last couple of quarters, I think we're showing a really good story around fixed cost control. Ben Jenkins is hassling the hell out of our organization on cost control. He's doing an outstanding job. And so in that short term, where's the risk? Maybe it's in working capital, right? Debt collections and so on. Again, Ben's team are working outstanding with our sales team to focus on our working capital. Beyond that, I think the risks in our business and I've been saying this for years, it's all about product, making sure that we understand the needs of the market and we're delivering efficiently into that complex technology, global footprint, sophisticated clients. It's delivering into that, I think, is our biggest challenge. We've got, without doubt, the best sales teams in our space globally, without doubt. And internally, some of the best product leaders globally. So it's just for us, just bringing it together, harnessing it. That's where I think the risks are. And if we do it even, just well, we'll dominate. I've got no doubt that we can win.
Good stuff. So on the cost side, as you approach break even and beyond, do you make any comment on the compensation plans and any changes that you might make there as regards sort of the split between cash and stock or anything else?
Yeah, so we're spending around about 15% on top of our staff costs, 16% on employee share schemes. and I'm expecting that to continue. Maybe we'll try and moderate it slightly over time. I think the opportunity for shareholders is, as our share price hopefully appreciates in the coming years as the market sees us for what we are and not the thematic that we're in, then the cost, the dilutive impact of the share schemes will fall enormously. So we talk internally a lot about ownership, making sure that our staff own the problems that they're tackling, own the customers' problems, own the outcomes that they're assigned. And so we also talk often in our business about ensuring that all of our staff have ownership in the company, and it's worked really, really well to date. I'm a big believer in that. And so, there is definitely where we acknowledge that there is a cost for shareholders today that is too high given the current share price, but that will change in the coming years.
Cool. Just down to our last couple of questions now. So any investors who've got questions, please pop them in and we'll hop through them. Question that's come in on regulation. Question is, can you talk to whether there are many issues on regulations across different markets, or do you find that it's sort of relatively aligned?
Oh, it's a hot area from data protection. So there's a lot of changes around data protection. The US is looking at rolling out some GDPR-like privacy policies. California is leading the way on data protection and privacy. There's all sorts of people agitating around consent. You're requiring kids to consent to the monitoring and filtering of the things that they do. There's competition regulation, particularly in the US, but not just in the US, including in Japan and Europe and the UK, which are now bringing the likes of Google, Apple, and Microsoft to account for their anti-competitive behavior, which is a huge opportunity for us. We have a full-time, wouldn't surprise you, we have a full-time capability internally that's just analysing all of the regulations that we must adhere to either sell into public agencies or to deal with student data. It's constant. It's a constant change. I think in the US, we've mapped it to about 170 pieces of legislation that we need to comply with. So it takes a fair bit of effort for us to do that. Now, as hard as that is, I think investors should appreciate that we take a very principled stance on these things. We have a very, a market-leading ethical framework and compliance framework on how we tackle some of the legal and ethical issues in our space. And I think my expectation is that into 23, our stance on regulation and our stance on the ethics of what we do will actually be a point of difference for us. We're actually going to be talking proactively to the market about how we handle some of the prickly issues in our business. And I'll give you a simple example. Say a child in a Catholic school in the US is, a girl is going to Planned Parenthood because she wants to find out about an abortion. Should that piece of information be made available to the school? Should it be made available to her parents? What would you do if the parents are separated? These are challenging ethical decisions that we find ourselves in. And that's just one of the many, as you can imagine, with the infusion of identity politics into education, you can imagine that we find ourselves at the crosshairs of all these sorts of issues. So we are well ahead of all that stuff. In fact, I think it'll be a point of difference for our business next year.
Yep, very interesting stuff. We're just, as I said, we're down to our last couple of questions. So we know that private equity is a big owner of businesses in the cybersecurity space. The question is that given Family Zone's now approaching break even, can you comment on what you see of the attention on the business from PE companies?
Yeah, that's true. Our competition are all PE backed. And yes, it's also true that we're probably undervalued. And if you look at us from an US currency lens, we're very undervalued. So is there an opportunity there? Is an arbitrage opportunity? Look, maybe it's the way I see it is this: is that firstly we've communicated to anybody who's shown interest that we're not for sale, because we feel like we've done all this work, including our investors have done all this work, and in the next 3 to 6 months, that will all manifest in something that's pretty amazing. And hopefully the market starts turning, or bottoms and starts turning, and the market starts looking for value, and then they'll see this impact-oriented business that's changing kids' lives, that's generating cash and growing strongly. I mean, we could be the best looking asset in the class in the next 6 to 12 months. It seems like a crazy time for us to succumb. So that's one thing. The other thing is there's, and I've spoken about this a lot, there was a lot of businesses in our space, founder-led small businesses, some really small, some relatively big, and that are for sale. And so, we're probably a complex acquisition for one of our competitors to swallow up. We've got everything that they have. We operate in different time zones. We're publicly traded, which is complex for them to deal with. It's going to be far easier for them to just tackle something that's local, that's private or PE backed, where they can both kind of manufacture prices that look accretive to their relevant members. So I feel like we'd be a hard nut to crack. And so I'm feeling pretty secure about where we're at today. We're not ignorant again to those dynamics, but we're really just kind of focusing on building value in our business, and that's our best protection.
Yep, sounds good, Tim. So I think I know the answer to this question, but it's just regarding the move towards profitability as you move through break even. I'm mindful that one of the risks that you mentioned earlier in the call was regarding working capital. So given the current cash position and the earnings growth, is it fair to assume the company now has sufficient balance sheet strength to move into ongoing profitability?
Yeah, look, we've still got a business plan that expects to get to sustainable cash flows from our current balance sheet. And that's fair enough. And I think we've communicated that to the market before. When I talk about working capital, I see that as a short-term issue for a business like ours. The advantage of our business is that we typically are invoicing schools, our clients, annually or more upfront. And so we actually end up with a positive working capital over time, once we get through that kind of break-even point. Ben, would you want to add any comments to this question?
Just unmuting. Look, I think it's about execution that we talked about earlier. So if we can execute on growth plans and grow strongly over the next 6-12 months, then we can get there. So it's that's not a guarantee by any stretch of the imagination, but if we execute well, then there's a path through.
Yep, sounds good. Just in terms of your engagement with the markets, can you comment on interest from other or larger investment banks in providing equity research, given the closeness to break even?
Yeah, I'm getting a lot of inbound inquiries from new banks, new analysts, and new institutional investors. Definitely busier the last few months. Ben and I are going to increasingly just kind of keep putting our shoulders to that wheel to broaden the base. The way I talk about it, to anyone to listen really, is we've got a top 5 or 8 of investors who are outstanding partners for our business, who really see the opportunity of the impact that we're going to make, the opportunity of being the category leader globally. And they've just been so helpful and generous in our journey. We've got retail who do their thing, and then we've got the kind of next group of institutional investors that we really need to start bringing into our base, and ideally some of those out of the US, which will become a big part of our focus in coming years. So that's really where Ben and I need to start spending more of our time, introducing our story to those new institutional investors, long-only investors, and particularly US type investors. Ben, again, your experience with this stuff too. What's your thinking?
Yeah, well, I think we're relatively well covered for a market cap of our size. There's 5 analysts covering us now. On top of Shaw and Euros, there's Argonaut, B Equities, and Wilson's Advisory. So not to disagree, we will look to expand that, but I think our coverage is reasonable for where we are right now, and we'll look to add a couple more to that again. The more the merrier, really.
Yep, sounds good. So final question for the moment that's come in terms of geographic spread, any plans to expand into the Asian countries, Japan, Singapore, India, anywhere like that?
Not immediately on the horizon. We're doing a bit of work in Spain, wouldn't surprise you. Spain has quite a nice market in terms of the way that schools are organised and funding is provided for devices. So at the moment, we're thinking, when we're thinking outside the English-speaking world, we're thinking into Western Europe. Yeah, hopefully in time, we get more bandwidth within the business, and we can do that. We definitely have the potential because Custodio have very established relationships in Japan and Singapore's, I think, their third or fourth biggest market. So it is coming. It's just a question of bandwidth.
Good stuff. Yeah, that's all the questions that have come in for the moment. So I might just give it a few moments to see if anyone wants to get in with any buzzer beater questions. Nothing's coming in. I think we might have covered all our bases there, Tim and Ben. So yeah, thanks very much to all our attendees for joining us today and for your continued interest in Family Zone. If we didn't get to your question today, Tim and Ben and myself will be happy to discuss further offline. We'll also look to make the video recording of this session available online for anyone who couldn't make it live. Really looking forward to the opportunity to talk to everyone again. Tim, I might pass across to you now for any closing comments.
Thanks, Tim. Look, again, thanks everyone for spending the time, for following us, and for those investors and analysts that I can see on the call. I'm just looking at you all now. Thank you for supporting us all this time. As I said, I think we've really now turned the corner in the business, and I'm really looking forward to being that company that is seen as the leader as the market turns and finds interest in growth stocks again, hopefully in the middle of next year. Anything from you, Ben?
No, nothing to add. Thanks, Tim. Thanks, everyone.
Great. Thanks, guys.
Excellent. Thanks, Ben. Thanks, Jim. Thanks, everyone. Chat to you soon. Bye.